Introduction to Anti-Money Laundering (AML). Introduction to the module. Anti-Money Laundering (AML) is a critical framework designed to prevent the illegal movement of funds within financial systems. It helps safeguard economies by detecting and disrupting money laundering activities that threaten financial integrity. AML measures play an essential role in maintaining public trust and promoting transparency in financial transactions. In this module, you will explore the fundamental concepts, techniques, regulations, and ethical responsibilities that guide AML practices to ensure a secure and compliant financial environment. Learning objectives. After completing this module, you will be able to understand the concept and stages of money laundering, recognize various techniques used in money laundering, identify sectors commonly targeted by money launderers, explain the role and evolution of anti-money laundering (AML) regulations, describe the ethical responsibilities and transparency standards for AML professionals. What is money laundering? Money laundering is a deceptive process used to disguise the origins of illegally obtained money, making it appear as though it comes from legitimate sources. Criminals use this technique to integrate illicit funds into the financial system, avoiding detection and prosecution. Money laundering enables criminals to profit from illegal activities such as drug trafficking, fraud, and corruption without arousing suspicion. It undermines the integrity of financial institutions and poses significant risks to economic stability and national security. Definition and stages. The process involves 3 key stages: placement, layering, and integration. Placement introduces illegal funds into the financial system, often through cash deposits or purchases of high-value assets. Layering obscures the money trail by transferring funds between accounts or using shell companies. Integration allows the laundered money to re-enter the economy as apparently legitimate funds, often through investments or large-scale purchases. The placement stage is often the riskiest for launderers, as it involves directly entering illicit funds into the financial system, where they are most vulnerable to detection. Layering may involve complex international transfers or the use of cryptocurrency to further obscure the origins of the funds, complicating efforts to trace them. Money laundering techniques. Techniques used in money laundering are increasingly sophisticated. Smurfing involves breaking large sums of cash into smaller amounts to avoid detection thresholds. Trade-based laundering manipulates invoices to disguise the movement of funds. Digital methods such as cryptocurrency transactions have gained popularity, offering anonymity and rapid fund transfers. Offshore banking and shell companies are also used to obscure ownership and move funds across jurisdictions. Shell companies are legal entities that exist only on paper, with no significant operations, assets, or employees. They are often used to obscure the true ownership of assets, facilitating illicit activities. Money laundering schemes often exploit loopholes in financial systems, leveraging complex financial instruments to mask illicit origins. Additionally, layering techniques, such as transferring funds through multiple accounts or jurisdictions, further complicate the traceability of laundered money. Common sectors targeted for money laundering. Certain industries are more susceptible to exploitation by money launderers. Real estate is a preferred choice due to the high-value transactions involved, making it easier to integrate large sums of illicit money. The financial services sector, including banks and money transfer services, is frequently targeted through fraudulent transactions. Casinos and luxury goods markets are also vulnerable, offering avenues to convert illicit cash into tangible assets. Emerging risks include the digital sector, particularly cryptocurrencies and online gaming platforms, which offer new opportunities for illicit activity. Anti-Money Laundering (AML). Anti-money laundering (AML) plays a critical role in safeguarding financial systems from the misuse of illicit funds. It represents a set of policies, regulations, and procedures designed to detect, prevent, and report financial crimes, ensuring the integrity of the global economy. AML practices are integral to building trust in financial institutions and fostering transparency in financial transactions. AML measures also deter criminal networks by reducing their ability to legitimize illegal proceeds. Effective implementation strengthens economic stability, and fosters public confidence in financial systems. Evolution of AML regulations. AML regulations have evolved significantly over time, reflecting the changing nature of financial crime. Early efforts were reactive, targeting specific cases of laundering uncovered through investigations. Over the years, proactive frameworks have emerged, introducing comprehensive compliance measures for financial institutions. Regulatory milestones include the establishment of reporting obligations for suspicious transactions and the adoption of customer due diligence protocols. The introduction of advanced technologies such as transaction monitoring systems has further refined AML processes. These advancements demonstrate the continuous adaptation of regulations to address the complexities of modern financial ecosystems. Importance of AML in financial systems. AML frameworks serve as a cornerstone in maintaining the stability and security of financial systems. They act as a deterrent to criminal activities by imposing stringent controls and penalties, thereby reducing the appeal of laundering illicit funds. The effective implementation of AML measures protects institutions from reputational damage, financial losses, and regulatory sanctions. It also builds public confidence in the financial sector, encouraging lawful transactions and investments. Robust AML systems contribute to a fairer economy by ensuring that financial transactions are not tainted by criminal activities. Global collaboration in AML efforts. International cooperation is vital in combating money laundering, given its cross-border nature. Organizations like the Financial Action Task Force, FATF, set global standards and promote mutual evaluations among nations. Collaboration between governments, financial institutions, and law enforcement agencies enables the sharing of intelligence and best practices. Joint operations, treaties, and information sharing platforms enhance the detection and disruption of laundering schemes. Global efforts ensure consistency in AML enforcement, closing loopholes, and creating a united front against financial crime. Key stakeholders in AML. Anti-money laundering. AML efforts require the collaboration of multiple stakeholders who play distinct yet interconnected roles. These entities work collectively to create robust systems that prevent financial crimes, ensuring the integrity of global financial networks. Their coordinated efforts help identify and mitigate risks associated with illicit financial activities. Effective collaboration between these stakeholders strengthens the global fight against money laundering and promotes economic security. Government and regulatory agencies. Governments and regulatory agencies are pivotal in developing and enforcing AML policies. They establish legal frameworks that define compliance obligations for financial institutions, ensuring that these organizations adopt effective measures to detect and report suspicious activities. Agencies also conduct audits and investigations, imposing penalties for non-compliance to deter negligence. Coordination between law enforcement and regulators enhances the ability to uncover and disrupt money laundering schemes. Public sector initiatives such as centralized registers for beneficial ownership information exemplify efforts to increase transparency and accountability. International organizations. Global organizations are instrumental in fostering cooperation across borders to combat money laundering. Entities like the Financial Action Task Force, FATF, set international standards and evaluate national compliance to ensure alignment with global best practices. Institutions such as Interpol and the United Nations facilitate intelligence sharing, capacity building, and joint investigations to dismantle transnational laundering networks. These organizations provide technical guidance and encourage harmonized approaches, bridging gaps in international AML frameworks and addressing emerging threats effectively. Overview of the AML process. The Anti-Money Laundering AML process is a structured framework designed to identify, prevent, and report financial crimes. This process enables organizations to comply with legal requirements, while safeguarding their operations from being exploited by illicit actors. Its implementation involves several steps, each contributing to the overarching goal of maintaining transparency and integrity in financial transactions. Reporting suspicious activities. Reporting suspicious activities is a cornerstone of the AML process. Financial institutions are mandated to monitor transactions for unusual patterns or red flags, such as large cash deposits, inconsistent account behaviours, or transactions involving high-risk jurisdiction. When a transaction raises concerns, institutions must file a suspicious activity report, SAR, with the relevant authorities. These reports contain detailed information about the nature of the activity, the parties involved, and the institution's rationale for suspicion. Effective SAR filing requires robust training for staff, ensuring they can recognise and document anomalies accurately. Timely reporting not only aids in preventing potential money laundering, but also supports wider investigations by law enforcement agencies. Maintaining a culture of vigilance and accountability is critical in fostering an environment where suspicious activity is identified and addressed promptly. Professional ethics. Professional ethics in anti-money laundering, AML, ensures that practitioners uphold integrity, fairness, and accountability while navigating complex financial and legal environments. Ethical conduct is not only a cornerstone of effective AML practices, but also vital in fostering trust and maintaining the credibility of financial institutions. Ethical behaviour helps prevent misconduct, ensuring that financial systems are not exploited for criminal activities. It establishes a standard of conduct that reinforces the importance of transparency and the responsible handling of financial information. Ethical responsibilities of AML professionals. AML professionals bear significant ethical responsibilities in their roles. They are expected to act with diligence, objectivity, and impartiality, ensuring that their work aligns with both regulatory standards and moral principles. Their duties include identifying suspicious transactions, escalating concerns appropriately, and avoiding conflicts of interest. Practitioners must also exercise discretion, respecting sensitive information while fulfilling their reporting obligations. Ethical decision-making is essential to balancing professional responsibilities with the broader goal of combating financial crime. Balancing legal obligations and client confidentiality. AML professionals often face the challenge of balancing their legal duties with the confidentiality owed to clients. Reporting suspicious activities, for instance, may require the disclosure of sensitive information, raising concerns about privacy and trust. Striking this balance necessitates a thorough understanding of reporting thresholds, confidentiality agreements, and legal exemptions. Transparent communication within organizations and adherence to established procedures enable practitioners to navigate these complexities effectively, ensuring both compliance and ethical integrity. Importance of transparency and accountability. Transparency and accountability are fundamental to maintaining public confidence in AML efforts. Practitioners must document their actions comprehensively, demonstrating that decisions are based on credible evidence and sound judgment. Accountability extends to maintaining accurate records, cooperating with audits, and addressing deficiencies in AML systems. Upholding these principles not only reinforces ethical standards, but also enhances the effectiveness of AML processes, contributing to a more secure and trustworthy financial environment. Highlights of the module. AML frameworks serve as a cornerstone in maintaining the stability and security of financial systems. International cooperation is vital in combating money laundering, given its cross-border nature. Governments and regulatory agencies are pivotal in developing and enforcing AML policies. Reporting suspicious activities is a cornerstone of the AML process. Transparency and accountability are fundamental to maintaining public confidence in AML efforts. Thank you. You have successfully made it to the end of this module.